Questions? No. Voilà. Very good.
Thanks. Thanks, Alex. So I have a few slides, a bit maybe also looking at the shorter term in our market. So this you have seen a few times. It's commodity prices in comparison to the stock prices. So this has happened 3 times, at least after the war, that prices were as low compared to other, let's say, hard assets like stocks. Or you can take oil, no? Is it high or is it low? But virtually it's at the same level as as in 1981. And you can compare it, what were the property prices in 1981 and so on. Doesn't mean it's going to change, but it's just something to keep in mind. And I don't want to be too long on this, but we have talked about this a few times. Obviously, we're structurally bullish. But we have overinvested in the sector. These are investments in oil and in energy and mining, inflation adjusted, and you see this huge spike into the end of 11, 12, and obviously then oversupply, and then you have this underinvestment since 10 years. But it's not a straight line, and you see this big rebound, for example, here, and I want to talk a bit on that. This is the chart of copper. So is it high or is it low? It always depends if you're long or short or where did you buy it. But you see that what happened after this huge bear market here, copper prices went from, let's say, from 2 to 5 into 21. I come to that later. And of course, if you have an industry which always has marginal cost, and the price goes from 2 to 5, you always have some production which comes back in the money and comes back on stream. A lot of mines which were abandoned or projects which were stopped. And actually since 3 years, you have more or less a consolidation which goes sideways. And uranium, for example, is a commodity which is here at the moment, which is quite obvious. You know, when you have prices at 20, and even the best mines have marginal or cash costs of 30, like MacArthur River from Cameco, which mines 15% grade. It's being taken on care and maintenance. And the companies decide, okay, we spare the uranium, we rather buy in the spot market ourselves, keep the mine shut, and deliver into our own contracts. And of course, it dries up the spot market, and then, you know, it happened what happens. And uranium went from 20 to 100. Now it's trading at 80. And you have gonna have this huge effect we saw in other commodities here in 21. And in uranium, for example, it's an estimation that around 30% of the whole production comes back on stream now in the next 2 years. And you know, that would be the same like in oil, the whole OPEC would come back into production. So is it a good time for buying companies with 50 times earnings? I doubt it. And afterwards, I want to say a few words about the impact of the speculants, the ones who listen to our how it's called, this internet seminars or whatever. I talked about this in copper in spring, probably in April, when you have had the situation, which I come to that later in oil now, that you have a huge short position on the financial industry and the commercials are long. We have seen this in cocoa, and it means that the financial industry takes on commitments to deliver physical product. And the commercials, which should be the opposite, they are buying in the financial market because it's cheaper. And I explained this, it's still on the internet, on our homepage. And months later, in June, you had this physical squeeze in copper. Because obviously, you know, you can't deliver if you're a financial player. So it's very dangerous. But copper is not as big as oil. But is the price high or low now? I think it's very low. because this is the estimates. It was done in spring, so we will see what's then really happening this year. It's from Glencore, a chart that the production in copper is going to decline around 7% this year, which is quite a lot, which it means the price is too low. I mean, the price is on a level that the production is declining, because of course it's not looking that bad, but you had production costs going up and so on. So we are in most of the metals at levels where you see production declining. And maybe here, why we believe, or I believe, that we get ending this consolidation which we had since 3 years. This is a global liquidity, M2, the long-term chart. This is 21. This is the shorter-term chart. And you see that the global liquidity was in a consolidation for 3 years. And it correlates with many markets. For example, this was the low, I think it was autumn 21. And if you remember back then, we had this, it's called the whipsaw effect also. You know, in 21, everybody was afraid of not having enough supply, you know, what's it called, the Chinese supply chains, blah, blah, blah. And the economy over-consumed. Because if you're afraid that you can't produce because there's not enough material, enough labor, you increase your inventories. It's called the whipsaw effect. I mean, the most extreme example was the cycling industry, which is a hobby of mine. Of course, if you have martial law, which we had, you know, the whole world was put on curfew, and I just looked up the definition of martial law in the US. Martial law, if your curfew is, you know, decided by the military. So they say, no, there was no martial law COVID because it was decided by the government and the police, or executed by the police, but at the end it's the same. So what happens, you know, nobody can do anything anymore apart from cycling. So everybody bought a bicycle, and then there were no bicycles, and there were no spare parts. And I did also buy tires, because I don't want to be the one who can't cycle because there's a lack of tires. The same happened in toilet paper. You know, I stock up my toilet paper inventory, and everybody can laugh at me. I don't care at all. I go to the toilet, relaxed, and with a soft paper. But now, what happens in this time? Obviously, then you had these spikes in commodity in 21. You know, iron ore went from 13, 15 to 170, oil to 120, copper and blah, blah. And obviously, it was even pushing up, what was pushing up inflation even more. So central banks hiked interest rate, they tightened, and you have 3 years of, you know, slowing economy. We might call it a recession or not, doesn't matter. And what also happens during these times, if you have a huge inventory level and then the economy slows, everybody starts to destock, because they see we sell less of our product. And the problem is, it's not linear. So if you have a huge inventory and then you sell, I just take a figure, 4% less. You don't buy 4% less of your raw materials, etc. You buy nothing for some time, empty stock. Hayek explained me this once with the watches, when you know, there's a high inventory level in Asia of these jewelry, watch traders, and then they sell less. Then they stop buying new watches for, I don't know, half a year. But it doesn't mean that no end market or the end consumer is not buying watches anymore. So now you see, if this would be a stock, you say it's breaking out on the upside. By the way, they don't look at M2 or M2. M3 is not published anymore, which would be the big difference from M2 to M3 would be the repo market, which is the biggest market, but it's another story. And now, why is it breaking out on the upside in August? Because the Japan, after 70 years of interest rate, Lime as zero, they decided we go to Lime as 0 plus, and the whole thing blew up, and after 3 days they had to stop, and they have to put liquidity into the system again. Now, if somebody reads the recent recommendation in Europe, you know, Draghi, he says we have to invest 5 times more than Marshall Plan. Of course, who pays? The central bank, well, through Eurobonds, etc. So good luck for the ones who are nominal investors in the euro for the next time. The dollar, no, now we have soon this these elections. I don't think it makes a difference. I have to just quote the Maria Zakharova from the foreign ministry of Russia, and she was asked what did she think of this recent discussion between the two. She said, you know, who cares on the Titanic what's happening when they're going to hit the iceberg in 15 minutes? But it doesn't matter. But if you listen, for example, to one of these candidates, I mean, it's copy-paste from Evita Peron. Just copy-paste, you know? So is this a good currency to be in nominally? Okay, then what is left? The Swiss franc. I had a presentation last week in Zug for the FDP party, and I was amazed. They're now more right-wing than the SVP. And I'm amazed how they talked about we have to take measures and influence the free market. For example, immigration, but also monetary-wise. And you remember the last time we tried to defend with zero interest rates, and it didn't work, and there were already discussions of capital controls in Switzerland. And when the next euro crisis comes, which they will do something. They have to. And I'm pretty sure that we will see other measures. So what is left then to flee or to go into? By the way, there's a reason why the gold price is breaking out. It was always a leading indicator for these developments, and it's breaking out against every currency, now against every stock market. And other things will follow. Also, stock markets are quite resilient. But I want to come a bit to the first thing about this capex. I mean, this was this huge explosion in capex in mining with high prices from 06 to 12. And now, then you have seen this is this spike here, and here you see it was mostly greenfield investments. And the difference between brownfield and greenfield is greenfield are new projects, completely new green on the green. Let's go on the green grass, and brownfield are expansions or mines which are taken back into production. So it means it is a production which is easily be done. For example, Glencore says they will only invest in greenfield when the copper price is $1 below the level where demand is being destroyed. So what's this level? When do you say the copper price is too high? I don't build the infrastructure because of it. I don't build the house. You have 2,000 bucks of copper in a house, so it's inexistent. But then, of course, then prices collapsed, oversupply, as we've seen, and then we have seen this rebound in capex. I showed on the first. Was da gemacht? Was ist jetzt das? Das ist eine andere Präsentation. Sorry, Alex. So I wanted to show this rebound in investments because of higher prices. Was this one? And here you see this rebound was mostly brownfield and much less greenfield. And this is quite obvious. So, then you take back the old investments which have been made. Maybe the project is not belonging to the same one anymore, or whatever, but it's the investment you made in the last time which comes back. This is exactly what's happening now with uranium. So it's the old mines which come back into the production, or investments where somebody else already paid for it. He lost the money, but the geological data is still there, and you have this rebound, and then you have the reaction on the production. And here the same again. But the problem is the greenfield is virtually not reacting anymore, and the problem is somewhen, you can't take just the old mines back. If all the old investment has been taken back, somewhen you have to start investing in really the new ones. I mean, obviously only if there is demand for it, and that's what's going to happen in the future, because most of this existing production or existing investments which have been done 11 and then have been abandoned, or it went bankrupt, somebody else picked it up. This has now been made, so the next cycle it will be new ones, and it is much more difficult, much more expensive. how I want. Yeah, of course. If you can take back McArthur River into production, in Canada, which is developed, you just have to hire the people back and maybe get some licenses. But if you have to build a mine, I don't know, in Africa, which is from scratch, at the end it takes 20 years or whatever. And maybe this is something which, in the oil market, it's a good time to talk about it. This is Jim Curry or Jeff Curry from Goldman Sachs. He just said 2 days ago, it's the most extreme situation he's ever seen in my life. It never existed. And this is the situation of the speculants and the commercial. So according to CFTC, we have the biggest or lowest or biggest short position ever by the financial since they published this data. It means the financial industry is maximum short and the commercial are the opposite, the same as we had in cocoa or in copper. It was only similar at the low of COVID, or maybe then going back, 15 years. And statistically, whenever you have such an extreme situation, you should have the biggest long position, because it's obvious, then the financial industry is never be able to deliver, so they have to cover. This has happened in June in copper, there was this squeeze in copper, of course. I mean, this is different to finance, because in the financial industry, it's only the sentiment forever, but here, I mean, it's not just a sentiment. At the end, it's physical product. And the commercial, if they're going long, which they shouldn't be, because they're naturally long, they are sourcing physical product from some speculators, CTAs, program, which say, okay, we are shorting it. It means we are delivering in the future this stuff. And what Jeff Curry, I don't know what's his first name, I don't care actually neither, but this is the big difference, for example, at the COVID low, when we had similar speculative or similar positioning in the future market, you had huge inventories. Why was that? Because, of course, if you shut in the whole population and they can't go out of the house anymore, of course, the oil demand is collapsing. And the production is obviously not reacting as fast. So there's a huge overproduction physically coming into the market. So the inventories are exploding. And that's why you had the situation that the Glencores of this world made huge profits, because they could buy oil for zero, maybe, or let's say at zero, and sell it forward at 30 for 2 years. Of course, you need to have storage capacity. That's why the tanker rates exploded. And then the whole thing is coming back, so you had everything goes up again, people go out, and then the demand comes back, and it consumes this inventory. So this is very different today. You see, are the oil inventories from Frontline, including oil on tankers. And you see, this is what I said about this, the destocking we saw in the last 3 years. And it's not just commodities, it's everything. You had the high in these inventories were the peak in oil prices or other commodity prices, and it was destocked now. So we have extremely low levels of inventories. And if now this, same as in copper, if now this, speculants, so they have to cover, which they will have soon, there is no physical oil. There's not physical oil there because there are no inventories. So this is quite a dangerous situation, and this is what this Jim Curry means. Now, the last time this speculative positioning was so low, oil prices multiplied by 4. But I think what's also different, it's not going to be as extreme. After COVID, it was also the production which was reduced, because when oil prices went down to 30, you have really a big part of the oil industry which is not economic anymore. So this production was cut, so they went out of business. And then the demand comes back, and obviously the production is missing. That's why you had this spike to 120. So this is not happening at the moment, because at $70 Brent, there's nobody forced to shut in the production. So I think it's not comparable really with the COVID low, but I think it's very comparable to the situation we had with copper a few months ago. And maybe there's also some political issues. I mean, the Americans sold their strategic oil reserves. There's obviously some parties in the US which don't want to have high oil prices before the elections. And then this ridiculous announcement of this International Energy Agency comes out, I don't know, a few weeks before the election, which is completely ridiculous. But this may be also having an influence. And then funnily, you know, then it's also, I mean, I don't have a clue neither, but I just look at the track records and, you know, these Glasenbergs and people in the oil industry, you know, a lot of them are billionaires, etc. And if you look what they do and say, nobody knows, but this is a few statements. I mean, Saudi Aramco says the problem is coming because of underinvestments. It's the biggest oil producer. Rosneft is the second biggest in the world. It says the same thing, and this ESG and misallocation of capital and these protections of the demand. It's like what Carla said in coal going down. It's completely ridiculous. Completely the opposite happens. Now, Exxon just said the same thing, and Vicky Holub had a speech in Davos. And she's managing the biggest oil industry in the US, and she said we're going to have an oil crunch in 25. It was not even talked about. So obviously, who knows? But I mean, these statements are how you calculate it. It's 30 to 50% of the oil production, this statement. So maybe something, I mean, they're not the biggest idiots, and they might know at least as much as some CTAs or some analysts from the financial industry. But we will see who is right this time. But my bet, according to the historic track record, would be rather on the Setschins and Glasenberg and all these kind of people. And then maybe a few words about steel. So everybody talks always copper and these kind of things. We as well, or uranium. But you know, you cannot just throw uranium there and make a fire. At the end, you need everything. And steel is like oil, energy, which is actually the same. It's used for everything. And I remember this is the development of the steel market. It's the same for copper, the oil. It all looks the same. And I remember 20 years ago, I read these books about you know, China developing and what it means for commodities. And I thought, oh, that makes sense to me. And then people here said, no, now it's over because the world is developed and nobody's going to use more steel anymore. And then I said, yeah, but you read this book about China and what it means per capita. You remember, Danny? and then people said to me, yeah, no, these Chinese, they're idiots, and so they're communists. No, they will never achieve something, and maybe stitching together some jumpers and so, but they will never be innovative, and so it's not going to be possible, you know. And now, and China was a net exporter of crude oil back then, and we know what happened in the last 20 years. Now again, maybe the same is happening now, and if I say, you know, I read now the same about India and all these kind of things, they say, no, India, no, it's never going to achieve anything, and Africa, because of the caste system and stuff like that. I don't have a clue about the caste system. I was never in India, not even in China. That was maybe because my wife, being Italian, she even complains about the food in France. And hopefully there's no Chinese, but it was not a statement of mine, but there was a statement of, she read it from Prince Philip, who said, if something has 4 legs and is not a chair, if something flies, has 2 wings and is not an airplane, and if something swims but is not a submarine, the Cantonese are going to eat it. So she read it, so that's the reason why I don't go to China. But okay, now we say, no, you read these stories about the steel consumption is ending. These are the iron ore imports in China. Unfortunately, it's in dollar terms, so it's a bit misleading because obviously the price effect is in, because the revenue is obviously price multiplied by volume. And the price of iron ore is virtually the same chart. It was like here at the bottom at 30, then it spiked to 170. And actually, since 3 years, it's going sideways. I mean, very volatile. It's between 80 and 120. Now it's 90. And in the first half year, you had this huge explosion in Chinese iron ore imports. I don't have a clue why this is so volatile. But I mean, I think it's pretty normal that in the second half of the year, it's much lower. But you know, if you take an average and so, you don't see anything that there is a complete collapse in iron ore imports in China. It's not really true. I mean, it's like coal and everything. And for example, this is interesting. You know, everybody talks about the Chinese real estate market. And it's always the Chinese real estate market which is collapsing and has overcapacity. It's always the Chinese economy since 25 years, and never the Swiss economy, and never another one, and only the Chinese is collapsing, but who knows. 10 years ago, the building industry was 40% of the steel demand. Now it's 25%. And you know, it's been taken over by other things, machinery, infrastructure, which is quite normal, but it's not that dependent anymore on only the construction industry. And then the same story what Carlos that we have talked about many times. This is steel use per capita worldwide. So here on the right column, you see some figures. For Austria is very high, so I have only two explanations. The first one is, you know, they are so, how it's called, disappointed that they are not be able to ski downhill as fast as the Swiss. They decided they wanted to be the fastest one uphill, so they build now all the fastest ski lift and cable cars. Obviously, that's one explanation. The other one is that Austria has a very large metal manufacturing industry, first Alpine, so they have a lot of steel imports, but it's not per capita at the end because they re-export a lot of it. And this is what you see everywhere. You know, the industrialized countries have a high steel consumption per capita, and then if you go to the so-called poorer countries, the same as in energy, it's much lower. Venezuela is interesting, you know, that this is what you get when you follow Evita Peron, Forza Fidel. You know, they don't have any consumption anymore. I read an article from Mark Faber, which is maybe not interesting for investment purpose, but definitely for history. In the 70s, Venezuela was the biggest importer of Dom Perignon champagne. And they said, no, this Marxist, this Evita Peron stuff, we will never do this in Venezuela. We're not as stupid, no. It's not going to happen to us. They have now a steel consumption per capita which is below 4 kilograms. And then you know the same things if you go to poorer countries like India. This is only a bit more 15% of the Chinese. And you go to Indonesia, so the same what Carlos explained in oil, and now you can believe that it's going to stay like this. Just to say, if you listen to these speeches of politicians, and I recently even listened to the speech of the general in Niger, I have to say, these people, I would vote for them, because what they do say is actually the same what Ludwig Erhard said 1950, and it's following in Austrian economics. These are people who are exactly doing what Röpke, and they read the book, The Road to Serfdom, which influenced Ludwig Erhard, and these people are doing the opposite from the people in the West, which are following the way of Evita Peron. So I'm not so negative that we can't see the same development as we've seen in China. And this is also what is the truth, you know. I mean, you can believe it or not, but this is the situation is China, the Indian economy grows 7%. This is at the moment the steel market grows 7%. The estimates are, you know, for the next 10 years, the same what we have seen in China the last 20 years. You see the same thing, for example, Indonesia, it grows 5%. Nobody talks about in the press, but Rosneft builds the biggest refinery in the world in Java for 30 billion. You know, these investments are being made. Maybe the West is not involved anymore. Africa, you know, it's very small, but it grows a lot. And maybe something at the end. I had a nice meeting with the chairman of, or the CEO of Archer Daniel Midlands, a very good company, which becomes attractive again. And then it buys 15% of all the crop in the world. And then there was the discussion about, you know, Russia and blah, blah, and the situation in Brazil, and this huge soya production in Brazil. And then people asked, why don't you go to Africa and to replicate it? And they said, yeah, we're not stupid. And we obviously checked where you have similar growing conditions, and it would be Mozambique. And it even has the same language because it was a Portuguese colony, but it says it's impossible because the whole coastline, all the suitable places for harbors are already occupied by LNG terminals. So, you know, these things, if something is abandoned on paper, easy, it's not always so easy in real terms. And this is the Australian exports of iron ore to China. And in my business, everybody says, okay, this is a company this and X, but it's mostly iron ore. Okay, it's not interesting and so. But if you really look at the mining industry in their charts in the last 25 years, who made money? It's oil, it's coal, it's iron ore. The commodities which are abundant. Why? Because they are abundant, so you can produce them on a sustainable basis. But nobody ever wants to invest. And now, what's the situation? Australia, I don't know, it's two places, Brazil and Australia, Western Australia. And obviously you need to have huge reserves which are close to the coastline, and in Western Australia there's nothing, you can just build the infrastructure, and then of course you are close to Asia. It's never be possible to be economic to bring iron ore from Russia, you know, with trains, etc. So this is a natural monopoly what you have. And it's not going to change for the next 20 years because it's the same going to happen with India and Indonesia. So just sometimes, you know, these changes in world, you know, politics or economics or whatever brings maybe sometimes a new business which was completely useless 30 years ago because there was no Australian iron ore going to the steel industry in Europe, as Carlos said. But sometimes it changes, and I think that sometimes gives also good opportunities for investment which might be not properly understood sometimes.